Hi friends, welcome back. Here's a quick video demonstrating reversing entries. Reversing entries are a choice, but it's a choice that many companies make because for reasons you'll see in a second, it can be quite convenient. Let me demonstrate how they work in this case. IndyCorp has 10 employees. Each employee earns $500 per day for each day of their 5-day work week. So each employee earns $2,500 per week, 500 per day, 5 days, $2,500 per week. So the total payroll for the company, given that they have 10 employees, is $25,000 per week. The employees receive their paychecks every Friday at the end of the workday, 5 p.m. At the end of 2024, the company recorded an adjusting journal entry to accrue the salaries earned by the employees as of December 31, but were not yet paid because notice that the company pays the employees on Friday, but just this particular year ended on Tuesday. The chief accounting officer chooses to records a reversing entry for all accrued expenses that will be paid with cash in the next accounting period. You'll see why this is so. So here's what we're going to do. We're going to prepare the adjusting journal entry to accrue the unpaid salaries as of the end of the fiscal year, and then we'll post them to a T account posting them to the general ledger. We'll then prepare the reversing entry, and we'll post the reversing entry to the affected general ledger accounts. Now, I want you to be real specific and notice the date that the reversing entries are recorded and why. We will then roll the clock forward a couple days and we'll show the journal entry that's recorded on January 3 when the employees are paid for their work for the week Monday, December 30 through Friday, January 3. In addition, we'll show the journal entry that would have been recorded at the end of the week when the employees were paid for their work if the adjusting entry we recorded at December 31 were not reversed. Okay, if you've read about reversing entries, please take a moment and give this a shot. Doing so will make it all make sense, and you'll have this down the rest of your career. So give it a shot. Before you do, here is the way I set up the information. You can see there's the calendar for the last week in December of 2024. The employees are off on the 29th, Sunday. They work Monday and earn $500 each, and there's 10 of them. They work Tuesday and earn $500 each, and there's 10 of them. They work Wednesday, Thursday, and Friday. So they did work New Year's Day, just to make the example work here. And then on Friday, they will get paid their money for the week. Each of them earned $5,000. I'm sorry, each of them earned $2,500. Okay. So we can write ourselves a note here. Each employee was given a check on Friday for $2,500. And so we paid a total of $25,000 out of our cash account for our employees for their work that we are so grateful for the week. Okay, so give that a try and return, and I'll show you how I did it. All right, welcome back. And here's what we do. We are, number one, we're preparing the adjusting journal entry to accrue unpaid salaries. All right. So remember, we are The date is January 31. And among the adjusting journal entries, we have to accrue that the employees earned a total of $10,000 for their work on Monday and Tuesday before they all went away for their New Year's Eve party. Hopefully they didn't work too late because they had to come in on the 1st. Okay. So for the adjusting journal entry, so let's call it the AJE accrued salaries. Would means they are incurred but not yet paid, so we need to accrue them in the books. And we have salaries expense. Of course, this is done on December 31, 2024. That's plus expense minus shareholders' equity when it's closed to retained earnings for $10,000. And salaries payable. Plus liability credit for $10,000. To accrue salaries earned but not yet paid at fiscal year end. There's a little explanation, and that is $500 per day times 2 days times 10 employees. $500 times 2 is 1,000, times 10 is 10,000. And that explains that $10,000 amount. Right, and that is the accrual. And so there's our general journal, excuse me. And in our general ledger, there's 2 accounts affected, of course, that we need to post to. Salaries expense, which is an expense account, as the name suggests, and salaries payable. So these are just 2 accounts that are among our many in the general ledger. That's a plus liability. And we're showing them in T account form for simplicity. And those are the way the liability is account is increased with a credit and decreased with a debit. The expense account is increased with a debit and decreased with a credit. So when we post, we're posting the 10,000, which is AJE, recorded on 12/31/24. And we now, the other side of that is a salaries payable. Okay. And so when we look at requirement number 1, prepare the adjusting journal entry to accrue unpaid salaries and post that adjusting journal entry to the affected general ledger accounts, we have done so via that entry and those posting to the general journal. Right now, remember that the chief accounting officer, so now we have properly accrued the salaries expense, and so when we prepare the financial statements, the income statement will include every penny of salary earned by the employee, whether or not we paid it during the year. And it will also, the balance sheet liabilities will reflect the fact that at that very point, 12/31/24, the end of the fiscal year on December 31, 2024, among the things we owe is we owe our employees $10,000 that we'll pay them on Friday. And we are good to go. We'll finish all our other adjusting journal entries, and we will be done, and we will prepare the financial statements. Now, remember, the chief accounting officer records a reversing entry for all accrued expenses that will be paid in the next accounting period. Well, these will be paid in the next accounting period because they'll be paid in January of 2025. Right? So we will indeed record a reversing entry. Now, here comes the important point. This will be the first journal entry on January 1, 2025. And I will show you why in a moment. Make this make sense. So stay with me, and this is going to completely make sense. But first, let's make sure we did all our closing entries. And of course, on this one, we would close whatever the total is, but let's just assume it was just 10,000. That's probably not the case, but we're closing it for its total. And the point of the closing entry, whatever the total is to start the balance over in the temporary expense account and start adding up salaries in the next year. Okay, temporary account. Exclamation point there for you. Hopefully that's make sense by now. Then we have also the permanent account. We don't close those, of course. And so salaries payable, we have a $10,000 balance at 1/1/25. All right, and that's what's in our general ledger. Let's go now to our New Year's Eve parties. We're done for the year. We prepared the financial statements. Let's go party. Now, when we come back, and indeed what we normally do is we program the computer to automatically reverse such entries. The computer will have a box you can check if you want this one reversed. Let's see how it happens and why it happens. What's the advantage of it? Right? So we are reversing this. So on 1/1/2025, in the new period, star, very important. We will literally reverse what we did above. We will debit salaries payable, and we will credit, salaries expense minus liability minus expense. What's going on here? We'll see in a second. For 10,000. And again, we are simply reversing the adjusting journal entry we made. Okay. Write ourselves a little, this occurred likely at 12:01 a.m. on 1/1/25, the new period. To reverse the salaries accrual recorded at the end of the 2024 fiscal year. We have now recorded the reversing entry in the new year, and let's post it and let's see what we accomplished by doing so. Well, this was weird. We have a $10,000 credit on 1/1/25. Reversing entry. And we have a debit to salaries payable 1/1/25 reversing entry. Okay, now we have accomplished the reverse. We're done. See why we did that. We come to Friday, and just like we always do, so keep in mind, on January 3, we're going to pay $25,000, $5,000 apiece or $2,500 apiece to the 10 employees, or $25,000. All right. And so that will look like this. 2/3/25. I'm sorry, 1/3/25. Credit cash for $25,000 and debit salaries expense for $25,000 to pay salaries for the week. Right. Now post that to those general ledgers, and we have, of course, the cash. We have a cash account that's getting credited. Just assume that happened. And we have the salaries expense getting debited. All right. Look at what just happened here. At this point in time, the balance in salaries expense is $15,000. Why not $25,000? Because it started after that reversing entry. We put it in a negative $10,000 position. But here's the beauty. That's exactly what we want. Because the first 10,000 of that 25,000 we expensed in the prior year. That's exactly what we want. Similarly, when we reverse the payable, the balance went down to zero. There is a zero balance in the payable account, which is exactly what we want. It worked. I'm giving the thumbs up there. All right. Keep working through that. See if it makes sense. Now, let's do the last question. What would we have done entry at 1/3/25 had we not reversed the salaries accrual? All right. We would have certainly credited cash for $25,000 because we're writing a check. We would have debited salaries expense for $15,000, and we would have debited salaries payable for $10,000. This would have zeroed out the payable that we set up and didn't reverse. This is the expense for Wednesday, Thursday, and Friday, and there's the cash. Okay, so the advantage is we don't need to go back and remember this. We can just do what we can have an accounting clerk, a relatively lower paid person with lesser skills, save their time and not to do the research and just do what they do every Friday. And that is what we actually did. Debit expense and credit cash. The system took care of everything by the reversing entry. Here, we didn't reverse it, and so we had to make sure we did this right and separated the $25,000 between the $15,000 that deals with 2025 business and the $10,000 that's payment for 2024 business. Okay, and that's how reversing entries are done, and importantly, why they're done. You have a couple of homework cases on that. And of course, ask me anytime. This is a very, very common accounting procedure, but it is a choice. But when the choice is made, it's to save from having to do this with all of the various checks we pay early in an accounting period. Go back and see what we accrued, what deals with this year's business, and what deals with last year's business. Nope, we didn't need to do that because we did the reversing entry. All right. Thanks for your attention. I hope you find that nifty. Hope it makes sense. If it doesn't, read about it in the book again, work another case on it, rework this case, rework it till it makes sense. And of course, ask me if you have any questions. Have a wonderful day. I enjoyed this module, and we will see you in the next module when we begin to look at the preparation of financial statements from that accounting worksheet at the end of every accounting period. Have a great day.